Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is March 8th edition of Market Outlook. Don't forget to sign up for this at www.marketgauge.com and you get a free copy every week. All right, well, markets got a little bit unhinged from the great jobs report. Let's drill into where the markets are um, right away. Okay, S&P 500. As you can see, we had a channel line that we've drawn in here. Market broke down convincingly from the breakout of the channel. Really couldn't get any momentum going. Now, what's interesting is you really did break down on the highest volume day since the breakout in February down here. Now, thing to remember is, you have a couple of cross currents. Number one, you definitely ran out of steam just at the breakout point. Now, we're actually trading underneath the breakout. So that definitely on a short-term basis is a cause of concern. Has anything been violated in terms of the long-term trend? Absolutely not. However, caution as a potential triple top going back to mid-November is potentially in play. Uh, let's take a look at the couple of the other indices because they're telling a slightly different picture. IWM really broke out in the beginning of February, and this trend line here or channel line where it broke out is critical support, and that's quite a bit lower. Even the old high back at the end of the year or in the beginning of December has not even been violated. So although that's a nasty looking candle, longer term support still very, very much intact. So quite a dichotomy from the picture on the S&P. IWM also interesting because let's take a look at the weekly chart because I think that tells a better picture. On the weekly chart, we literally have had over a year, maybe even a year and a quarter of a base. We broke out of that convincingly, couldn't really get a head of steam going. We have on a weekly basis a bearish engulfing pattern, but really good support around that 120 level. So if you take a look at the Qs, the IWM relative to the S&P, that should offer some pretty good support. Now, what I'm going to do as well is I'm going to put in this trend line right here because that's also telling an important story. So again, the fact is that you have good support just around the breakout point of that consolidation for several weeks back in January and February. So a break of that trend line would definitely bring you down to this rising 65-week moving average, which comes in around 115. That is really your critical level of support. So could you get a 4 or 5% move down in this volatile index and still have the long-term trend intact? Absolutely. Now, what was the cause of all this? This was TLTs. Taking a look at TLTs on a weekly basis, you can see you had this massive panic top here or potential top and a very good size correction. And taking a look at the daily charts, you can see we have broken down and under the 50-day, we after the initial break of the 50, we tried to get through it, couldn't, and as you can see, this sharply sloping 50-day moving average flattening out, moving slightly down, which is an additional warning sign. Plus now we're down underneath the 100-day moving average with a breakaway gap to the downside. So we really need to recover this 100-day moving average. But the fact is that the deepness of this correction definitely calls into question the longer term trend of lower rates. It's very possible that we saw the blow off top in longer term rates and just rates in general, certainly here in the US. The kicker or the problem is UUP, which is the dollar. Considering that we are the strongest economy, our rates, even at relatively zero on a short term basis, are the highest in the world, along with a backdrop of a strong economy. Our dollar is just flying. The Fed is acutely aware that our multinational corporations are going to be under tremendous pressure to be competitive compared to European companies that it's competing against. Let's take a look at FXE, which is sort of the flip side. But as you can see, the trend in the FXE is just really collapsing. It looks like it's certainly heading to par, and there are just further troubles, deflationary pressures in Europe, which just at the moment don't exist here. So let's take a look at a couple of the market internals. As you can see, the VIX turned above the 200-day moving average inside the Bollinger Band. Plenty of room to move either side. But considering the 300-point move down, that's relatively muted. Now, one of the things that I want to point out is that the McClellan oscillator definitely broke down here, gave you a pretty good confirmation of the 10-day advanced decline and the up-down volume, which is our shorter term indicators. So essentially what we look for is a cross of being above the 2000 level on advanced declines, being above the 60% level and turning down, with a confirmation of the McClellan going beneath the zero line, and all those three lined up. So there's definite pressure on the markets here. You definitely have a bona fide sell signal which kicked in about 2-3 days ago. And interestingly enough, here's the issue, is that with that sell-off, as you can see, a lot of these indicators are getting to not quite oversold yet, but not that far away. So another day or two of continued pressure could set up a potential buy signal, at least on a short-term basis, where the 10 and the 10-day advanced decline, the 10-day up-down volume goes underneath those demarcations here, oversold, pull back over for a short-term rally, while the longer-term trend in market internals are still down. So wouldn't be surprised to see a short-term bounce not far from here or even around here, and then run back into trouble at the 10-day moving average. Let's go back to the S&P and see where that comes in. And so 10-day moving average comes in around 211. So a good little spike up here if the market gets oversold. So it could be that the market gets to an oversold condition right on that 50-day moving average, gets a short-term bounce, and then continues to roll over. That's sort of the scenario, and then find some support potentially right around the 200-day moving average, which is about 200, as you can see. Now that 200 level is clearly really critical support. You can say undercutting 200 and some really good closes underneath those lows, which I guess were about 198, is really, really important. Gold in deep trouble. Take a look at this. Higher rates, definitely not good for gold. Gold had been looking much better for the year, and we were hoping that you might get some sort of bounce here for the gold bugs, but not to be. Back into a bearish phase, breakaway gap to the downside. This market looks like it's heading to new lows. Now it might find support around that 110 level. But again, with the prospect of higher rates here, or at least no more easing whatsoever, you're going to see more continued pressure on gold. So the gold bugs that look like they were in better shape earlier this year with that 10% move initially, definitely undone, and this market is under pressure. One last thing we'd like to cover is oil and Russia. Oil looking like it's potentially basing out. We really need a move above the 19 level, which was the last two attempts, last couple of days, traded above the 50-day moving average and stopped just around that 19 level. Again, if we can get that 50-day moving average to level out and get a couple of closes above it, as well as take out that 19 level convincingly, we could have a bottom in oil. Other than that, still in a strong bear phase. And again, any consecutive closes or a couple of closes underneath the 18 level in USO would definitely be a negative sign and show that the market might be heading to new lows again as well. So the fact that you've been able to hold that critical 18 level, that's an important swing point to watch. Okay, that's it for now. You got a pretty good overall macro picture. Oh, before I go, let's cover Russia. Okay, again, lots of strangeness or more of the same coming out of Russia with the assassination of the opposition leader. But the market seems to have held up relatively well considering when that news broke. But one thing here is you want some closes above the recent highs, and that would definitely confirm that the recovery phase is in, which would be good. Other than that, market's still looking pretty iffy. You could get another test of this rising 50-day moving average, which is, quite a distance away. $1, on a $17 stock, significant percentage. And so let's watch that. But you should find some decent support around the 16 level. And again, breakout confirmation to a potential rally up to the declining 200 and some pretty good short-term or intermediate-term resistance around the 21 level, 20 to 21 level, where a major gap was started from. All right. Hope that helps. Again, overall, the picture is short term, we probably could have a little bit more weakness. Some of the market internals on a short term basis, oversold, potential bounce in place, but the overall trend potentially under pressure while the market works off the reality of higher rates. That's it. Bye for now. See you next week. Hope this helps, and stay frosty.